Good afternoon, everyone, and welcome to our Learn from the Best Masterclass on integrating climate change into business strategy. My name is Georgia, and I'm delighted and excited to be your host for this fireside discussion today. Before we start today's session, I wish to acknowledge that this masterclass is being broadcast from the lands of the Kulin Nations in Victoria. We would like to acknowledge the First Nations people across Australia as the traditional custodians of the land on which we are all gathered here virtually today. I pay my respects to their elders, past, present, and emerging. In early August, the UN Secretary-General responded to an updated assessment report of climate science by calling it Code Red for humanity. The landmark report stated that there is no remaining scientific doubt that we as humans are fueling climate change. Whilst many investors, regulators, and customers increasingly acknowledge climate change as one of the defining challenges of our generation, one that's affecting business operations, reshaping markets, and the structure of the economy, many businesses have not yet integrated climate into their core strategies. Well, today's masterclass is all about exploring the different climate risks and how it affects all of the economy and your entire value chain. The session will draw on the recommendations of the Task Force on Climate-Related Financial Disclosures to discuss strategic responses. I'm delighted today to be joined by Dirk Visser, a lecturer and program manager for professional development education at Monash Sustainable Development Institute. Dirk has a particular subject matter expertise in ESG and business and sustainability, and he designs and teaches it into a variety of academic and professional development programs, including one you'll learn a bit more about later today, which is climate change and business risk. I'm also joined by Pablo Baruti. Pablo is the founder and managing director of LTorum, a non-for-profit library and resource centre dedicated to helping people inside and outside finance advocate for a sustainable financial system. He is also a senior investment specialist at Stewart Investors Sustainable Funds Group and a board member of the Responsible Investment Association of Australasia. The format for today, the session will run for approximately 45 minutes and be followed by Q&A. After the discussion, we'll open up to you to ask questions and make any observations and comments. Please click on the Q&A icon at the bottom of your screen and send your questions through. For now, I'll hand over to Dirk and thank you all very much for joining us.
Thank you very much, Georgia, and good afternoon, everyone. It's a delight to be with you this afternoon. We're really looking forward to the session, and as Georgia said, encourage you to send any questions through so we can address those later in the session. I'm going to share a few thoughts on this topic of integrating climate change into business strategy, and also bring Pablo in to get his particular insights as a practitioner in the field, in the investment field, as we navigate that. But as Georgia said, it's a topic that is obviously in the news a great deal, but it's also something which we are all have a lived experience in different ways. And for many people, the bushfires in Australia at the beginning of last year or end of 2019 was sort of a particular awakening moment. For others, there've been other things they read or experienced that have really brought them to this. But we know this is absolutely accelerating in terms of its significance from a business and a governance perspective. And so we hope that today will just give you some sort of a glimpse into some of the ways in which companies are starting to think about it and how an approach can be crafted to deal with this. And to start off, in case anyone, for some reason has to run off early and can't stay to the end, I'll give you the headline message. So if you need to go and tell, your family what was this webinar all about, or your colleagues what it was all about, I'll give you the key, take-out messages. Firstly, with regards to climate change, it is more serious than you think. And I'm going to make an assumption because maybe some people are really on top of this topic, but I guess in general that would hold. Secondly, as a takeout, it is technically easier to solve than you think. We have the solutions, we've got roadmaps and ideas of how to address it from a technical perspective. That includes something, cost-effective solutions. Thirdly, however, it is institutionally more complex to implement than you think. And I'm using institutionally sort of quite broadly here. You can think of it organizationally, society, socially, so in society or in different companies or even in our own lives. It is actually more complex to implement than you think. But on a positive note, it is possible. It is possible to tackle this really significant challenge. So to unpack that a little bit more, as Georgia highlighted from the latest Independent Panel on Climate Change 6th assessment report that was released last week, it reiterates again that the climate is absolutely, undoubtedly warming, and as the warming is accelerating. We are already on about 1.1 degree of warming above the pre-industrial level, and that this warming that has been observed is absolutely man-made. So they've factored in all the kind of natural factors, differences, in sun's position from the earth or volcanoes or any other natural factors. And it is the change in anthropogenic or man-made emissions that is driving the warming which we have experienced. So it's absolutely clear it's happening, and it is us in terms of humanity. It's also unprecedented in that the warming which we have experienced and expected to continue, for the next few decades has not been experienced in modern history. So you'll see there's a little gray bar on that graph that indicates a temperature range of about 0.2 to 1 degrees, which is the previous sort of warmer range, about 6,500 years ago. But we already exceeded that and are expecting to exceed that even more in the next few years. So whatever territory we're going into now is not something that we have experienced as humans in any form of modern society for at least 125,000 years. Now, when we talk about 1 degree or 1.5 or 2 degrees, which is often mentioned, they might sound like fairly small changes. And you say, well, how can such small changes be so significant? And here it's helpful to think about a distribution curve like the one on this graph, where the standard or baseline, this is not a pre-industrial baseline, but a different baseline, indicates a normal distribution curve, and then a new one, sort of the yellowish golden one, indicate what happens if it warms slightly. So whilst the mean only moves a little bit, what really happens is you've got a significant increase in your extremes, sort of on the right tail of this graph. So if you look at that table, you can see, for example, if you look at temperatures above 40 degrees Celsius, it goes from about 4.4% frequency to 8.2% frequency. So almost a doubling of the frequency of which, the temperatures, these extreme temperatures. And this is something picked up again in the IPCC report, where they highlight that not only can we expect an increase in the frequency of these rather extreme events, but also an increase in the intensity of these events. And these are things that really matter in terms of the impacts which we then experience. And as this graph indicates, you think about precipitation events or rainfall events that are usually the largest source of insurance damage, through storms and the flooding that follow. And if you have a 1.5 degree warming world, then already it's likely that we have, that a 1 in 10 year event is a 1.5 times increased frequency. So it then becomes a 1 in a 6.5 year event. Or under a 2 degree warming scenario, and keep in mind we're already at over 1 degree, it is a 1.7 times more frequent. So it almost becomes once in kind of just over 5 year events. But not only are they more frequent, these events are also more intense. So under a 2 degree scenario, these events are on average about 14% wetter, so causing greater impact. And this is entirely consistent with the climate science in terms of the energy that's built up in the system that needs to be dissipated. Maybe of more relevance in Australia is concerns around drought. And the same story here, that under a 2-degree scenario, kind of 1 in 10-year drought event is 2.4 times more likely to occur. So you can almost expect a 1 in 10-year drought to occur 1 in every 4 years, and with the increase in intensity. So this is something which, why, it's called a code red, or why the impacts are so significant, not just socially, but also for business. And if you look then in Australia at, where the warming has occurred, and what this increase in this frequency, what that really translates to is, this Australian map on the left, with a very dark red, is from the Actuarial Institute of Australia, where they modeled the increased frequency of these extreme events. And you can see that these kind of, in large swathes of the country, this kind of dark red means, there's already a 1 standard deviation above the baseline. So, a far greater frequency of these extreme temperature events. And this occurred in the summer of 2020, so sort of, December 2019 to February 2020, which was the period coincided with that, of this extreme bushfires. And that whole time in Australia, that season, was in the end the highest insurance loss event ever recorded in Australia. So you can see a whole list of climatic events that cause, great devastation. And we only highlight here the insurance losses of impacts, direct financial impacts on business, but we know that the broader socioeconomic impacts are far greater than insurance losses. But this is just to illustrate that there's this direct link between, increased temperatures and the frequency of events, and then, those actually occurring and causing significant damage. Now, all of what I've described thus far is sort of what we call acute risks. So these kind of short, sharp pain events, as you would, that driven by physical changes that leads to a once-off extreme event. But we also know that for companies and as citizens, we also need to be concerned about chronic impacts of climate. So that's a kind of more slower, long, gradual changes. So for example, changes in rainfall patterns that might growing certain crops not feasible, or changing where we can grow certain things, or that leads to lower water levels that impact, not only shipping and things like that, but also hydro energy, or the runoff of water that's available. So those are the kind of chronic effects, and those are also things that business have to really consider. And then there's also, first and second order impacts. So first order impacts is sort of, many of the things that I've already highlighted. So the direct impacts of a physical event and how it impacts operations. But what is often neglected when companies have to think about climate and climate risk is second order impacts. So those are the things that happen outside of your operations, but are deeply material. So that could be in your supply chain, or it could be things that impact, customers or employees, and in that sense it affects you. Or it could be the impacts on broader economy or the GDP. So think again, back to the bushfire example. We can measure the impacts of direct losses from, buildings, the structures burned down. But the broader loss of the GDP, so areas not attracting tourists or people moving away from an area, those are sort of the second order impacts that have, that can be very, very significant for organizations. And so to deal and to counter kind of with these physical impacts, and because of the greater awareness, all countries in the world signed up in 2015 to the Paris Agreement. Now, this was a long time coming. This was the 21st meeting of the Conference of the Parties to the UN framework. So it was a long time coming, but it was really a landmark agreement that commits all countries to try and limit global heating to well below 2 degrees with an intent to keep it below 1.5 degrees. And so all countries, whether developed or developing, are bound under the same agreement. And a few of the things that are part of that is that every 5 years, they need to submit their pledges, to the COP, and then these get ratcheted up over time. So this year's COP, or postponed from last year, happening in Glasgow, is quite significant because it's 5 years, barring the one skip last year, since Paris. And so that's really to review how have we done as countries on these pledges. And from these pledges, it is significant because that really shapes not only public discourse, but also regulation, and then what companies do as a consequence. And we know that the next decade is really, really crucial, because the carbon budget, the amount of CO2 that we can still emit to give us a chance of staying below 1.5 or 2 degrees, is rapidly running out. So in fact, at current levels of emissions, we only have about 7 years left to stay below 2 degrees, or 25 years to stay, 7 years to stay below 1.5, or 25 years to stay below 2 degrees. But obviously, you're not going straight line and then fall off a cliff. So it's these kind of deep, cuts that need to occur straight away in order to give us a chance. And so you can see, that if we start doing with fairly rapid declines now, we could, get to a state of net zero by 2050 in order to still meet that 1.5 degree target. And so the idea of net zero really flows from the Paris Agreement and the science, which is, well, that's what we need by mid-century to stay below these thresholds. And that then really is driving now the conversation among countries and amongst companies of where we need to get to. And whilst Australia is not necessarily seen as a leader on sort of in the global landscape on climate, our climate pledges, there has been significant movement, and also movement towards this net zero, idea of net zero, with all the states and territories signing up or pledging, making net zero commitments. And more significantly, also a whole host of the largest companies in the country adopting net zero targets to say their intent of where they are driving, what they are driving towards. And these are therefore in line with what science is saying is required. And the idea of net zero is really powerful as a way of thinking about it, because it makes it clear that whilst there are a lot of things you can do in your own operations, it is a whole of economy transformation. And again, thinking through a risk perspective, it helps to think through where are all the potential risks that can occur across my organization. Now we know, and this is from work done by Climate Works Australia, part of MSDI, work that modeling they did, with CSIRO, that Australia can reach net zero with existing technologies. So across all those different sectors, electricity, built environment, transport, industry, and agriculture, that to a large extent, we can reach it with demonstrated and mature technologies, meaning things that are already proven and cost effective to a large extent. But there's some progress that we still need, to get to that final bit in kind of emerging solutions. So things we already know how to do, but they're not yet sort of at scale or not yet cost effective, and therefore more investment is needed. But the key takeout is really that, we can get a very long way on that journey, at least for the next decade, if we just continue to scale up these demonstrated and mature solutions across these different sectors. And that's renewable energy, energy efficiency, circular economy, and a whole host of other existing technologies. And we know that this transition is underway, because of the amount of EVs being rolled out, the rapid growth of renewable energies driven by the decline in prices, the investments going into this. So we know that this transition is underway to get us to net zero. And if you again then think, as a company or as an organization, so what does this mean? What is a strategy for decarbonization look like? It's really built on these 4 pillars of decarbonization. And this is something that every organization can and then should be doing. First pillar is to reduce energy waste or reduce energy use as far as possible. So think, elimination or efficiency. So as far as possible, we want to drive that down. That's also the cheapest form of abatement, or the cheapest form of mitigation, because you save energy, so therefore you don't use anything. Then secondly is to transform the entire system to 100% renewable electricity. And as I said, that we've got a good sense of how to do that with existing and mature technologies. Built on that then we electrify everything. So that means all processes that currently use other forms of fossil fuels, for direct use, whether it be in transport or for heating or industry, gets electrified. And then there's still a residual of things of non-energy emissions. So for example, in land use, or things like cement potentially, or that we say we don't yet know how to reduce that, eliminate that entirely, and then it sort of offsets as sort of a part of that. And so that's sort of a decarbonization strategy that every organization can follow. And so to sum that all up, so one side for organizations, there's the kind of these physical risks that they need to contend with, chronic, acute, first order, second order. And then there are the transition risks. So the risks that occur because of the rapid change towards net zero. And those changes, as already alluded to, occur because of technology changes and innovations, changes in policy or legislation or standards, anything that sort of, a standards-based approach, or changes in kind of societal adaptation. And that could be also society deciding to move away from certain things because they deem it no longer desirable or suitable for the future that we need. And so as an organization then say, well, if you acknowledge this is a really serious problem, we need to do something purely from a risk perspective, you can then say, well, we need to climate proof our infrastructure, so make sure that everything that's kind of exposed to climate risk can deal with this changing climate. But then secondly, also, we need to get on a net zero trajectory with our emissions, and be aware of all these changes, so we are not caught unawares, so that the changes that occur do not leave us stranded, or with significant supply chain disruptions, or people not desiring our products and services anymore because they are not compatible with a net zero world. So those are sort of how an organization can think about it, but also just outlining these key physical and transition risks. So at this point, I'm going to pause and invite Pablo Berruti into the conversation. Was introduced at the start. Pablo is someone who is very knowledgeable about investments and thinks a lot about climate. And so it's really active in this. And it's great to have you here, Pablo. And I guess my question to you, firstly, is why are investors, now taking climate so seriously? What is it that is, changed, and what are the things that they are really looking for, concerned about with regards to climate?
Thanks, Dirk, and thank you for having us along to this. And I thought you framed the issue beautifully there with your introduction. It's a really compelling case for incorporating these issues. And I think a lot of those reasons that you outlined are the same reasons that investors are thinking more and more about the issues around climate risk. And but there are many drivers. So some of them are in the traditional investment range of considerations, risk and return and that type of thing. However, we also face regulatory pressures. So we see whether it's in Europe, the SEC in the US, and even here with APRA and ASIC paying more attention to what investors are doing and saying in relation to climate in particular, but more broadly sustainability related issues as well. We see a huge amount of demand for investment products which are investing sustainably, and they're monitored by organizations like Morningstar or the Responsible Investment Association, where financial organizations and institutions obviously want to be able to satisfy the demands from consumers and the investing public for products that are well aligned with climate goals. In all of these areas, none of them are new. So we've seen these trends for many years. I think what perhaps is different now is that there's a couple of things. One is that you're seeing convergence of issues where the regulatory pressures are creating the investment risks, and so they're no longer separate considerations, they're coming together. Similarly with things like activism, for instance, whereas in many years gone by, you might have protesters turn up to the foyer of big banks or other financial institutions. Now you're seeing shareholder resolutions presented at company annual general meetings for the last sort of 5 years or so. And we initially, when they were being presented by smaller shareholders, largely linked to NGO groups who were primarily interested in climate as a issue of concern, they were rejected by the companies, or the companies advised their shareholders to vote against these resolutions, and they still do. And investors also then sided with the companies and rejected those. But in more recent times, so over the last 2 years or so, you've actually seen a good number of those votes receive majority support from investors, even with the companies recommending that they vote against them. And so you're seeing this convergence of public policy, activism, regulatory landscape, and the actual risks associated with climate all coming together. The other thing that I think has shifted is, and why you see that there is such a big change in investor thinking about these issues, is the uptake in net zero commitments. And I'm sure we could talk at length about how credible some of the commitments are being made by companies and by investors, but generally it's very unlike investors as a broad group to commit to something where they don't know how to get there, or to commit to something which is not directly related to a financial outcome, whether it's a risk parameter or a return parameter. And so to see what, by some estimates, is half the world's professionally managed assets committing to net zero in their portfolios is a very significant change to the way that investors ordinarily do things. And I think that is, aside from the convergence, I think it's the recognition that we are, as your chart really dramatically points out, the window that we have through which to act and to escape the worst impacts of climate change is narrowing very quickly. And so there's no longer really any runway to kick the can down the road for others to deal with. The need to act and the need to reduce emissions is now. And so I think that recognition by investors, even though they don't quite know how they're going to get there, is a really important one.
Right, and I guess then, for, not everyone on this meeting is necessarily in a large listed company, some might be, but just if you apply those same principles, so from your knowledge of the financial and strategic impacts of climate, what are the kind of things that you would want to see from a company, regardless of whether you can actually invest in, but just as an advisor, to showcase that they really get it, that they sort of are on board? What are the kind of things that therefore you think companies should be doing in order to deal with this?
So there are kind of practical actions, but then there's also the way that companies are explaining their strategy in relation to these issues. And so I think the day is certainly over where companies can kind of split out into some kind of corporate sustainability report, or in a kind of a philanthropic function, the considerations of climate related issues. I mean, these are core strategic business issues, and it is not just about the operations of the company. So of course we all ought to be reducing energy waste, as you said, switching to renewable energy wherever possible, transport systems, other systems switching to electrification, but actually looking across the supply chain. So we've seen, for instance, food price spikes as a result of climate-related impacts. Just most recently this year in Brazil, where they make a very significant proportion of the world's cereal grains and other breakfast commodities, and those through their fires and frosts and other types of extreme weather events have seen those food prices go up. So if you're a consumer goods companies relying on those supply chains, you need to be thinking very carefully about how you build more sustainable and resilient supply chains. More broadly, COVID has taught us that as well, because we've seen bottlenecks around supply chains in all hosts of industries. And so I think if you play forward the increasing impacts, the physical impacts of climate change, the increasing regulatory imposts and other drivers, you need to be thinking very carefully about how you get your key ingredients and your key suppliers to be able to run your business. You also need to be thinking about your product mix, because in the same way that you as a business might be thinking about how to integrate this into your operations, other businesses are doing the same thing. And so if you're producing products which aren't energy efficient, which are tied to fossil fuel related generation of energy, whether it's in generation of electricity or in transport or in heating and cooling, those types of concerns should be very relevant from a product perspective, because the best place to actually deal with those issues is in the design phase, which is down to those companies that are making and building those products. And so strategically positioning yourself, one, to build better products, but be ensured that you're in the right end markets. And you can look at electric vehicles as a really good example of this. So if you're as we don't manufacture cars, and unfortunately in Australia anymore, but there are a whole host of companies in Australia that were linked into the manufacturing of vehicles, and still are, I'm sure, who, as we move to electric vehicles, they have less moving parts, they require less servicing. So it's not just about the switching of fuels, it's the entire way that vehicle operates, which companies, if that's a key market for your products, you need to be thinking very carefully about. So if you're an investor or if you're a business leader, you really need to be thinking strategically, you need to be thinking holistically, and you need to be really looking to back those solutions in and backing into those markets which are more likely to grow in the future as opposed to shrink. I probably just I think the Monash Climate Works does fantastic work, and the transition pathways you've mentioned in those broad categories are really useful. Another tool that I found quite useful is Project Drawdown, which is a US-based research institute, which has identified 80 climate change solutions, which really get into the nitty-gritty of the types of changes in agriculture, in transport, in energy that needs to be made. And I think just taking a cursory look at those 80 solutions, most businesses will find there's some kind of relationship to what they do day in, day out that is linked to climate change solutions. So we can all be part of resolving this issue together.
Great, thanks, Pablo. And so it's clear that whether or not you are sort of in the front line, like a fossil fuel company or not, even if you're a smaller company, you're probably in the supply chains of some of these companies that are making these commitments or that are facing it. And you're certainly exposed to the same social drivers and regulatory drivers that are transforming the economy. And I think therefore it makes it so relevant for almost every organization of every size and sector. And so just to a few more thoughts before we hand over to having a bit more of a discussion and a Q&A session. The question, if I at the start said it's really serious, it's technically possible, as we've highlighted, Project Drawdown or the decarbonization pathways. We know what the solutions are, yet it is incredibly institutionally complex. And so I think I've already highlighted maybe some of those reasons. Maybe just want to unpack quickly kind of 5 sort of those reasons, and in posing it, it also hints to actually what you therefore need to do as an organization. So firstly, there is deep uncertainty, and there's not uncertainty that the climate is changing or that it's warming and so on, but we don't know exactly, and no amount of science can tell us exactly. Even if we know we are more likely to have frequent storms, we don't know exactly, is that next year or the year after, or and how bad will it be and where exactly will it hit. So there's uncertainty about that. And then there's obviously uncertainty also on how rapidly we transition. We might say, well, this is what a net zero pathway looks like, but there's not just one way of getting there. There are numerous pathways of getting there. And so companies actually need to navigate this conceptual trade-off on one side between physical risks and transition risks. That, the less world acts, the more physical risks you are exposed to. And on the other end, the more rapidly we change, there's less physical risk, but obviously the transition risks become more pronounced. And everywhere on this trajectory, it's a continuum, because there's no place where there's no physical risks or no transition risks. So all along this, no matter where we end up, there are physical risks and a bevy of different transition risks that you need to navigate. And this uncertainty is therefore why people say, well, actually we need different planning tools, different sort of ways of understanding and preparing for the future than we've had in the past. And that's where the ideas of doing climate scenarios that are challenging and not just trying to predict the future, but really prepare for the future through doing things like climate scenarios are really, really useful. So that's the first thing. The second reason is that why it's so institutionally complex is because it requires a very long-term planning and commitment. We're talking here about actions that need to be, plans that need to be made and actions that need to be executed over a 10, 20, 30-year time horizon. And we know that most corporate plans are 3 or 4, maybe 5-year plans. Now, whilst there are certain institutions, that build infrastructure that last a very long time, their corporate plans will change so many times, during the lifetime of that asset. But here you need to make, a plan and commitments and follow that and retain momentum for that over those 30 years, whereas we just highlighted, many things could change, and so you might have to accelerate or de-emphasize certain things. Not all technologies might pan out exactly as you've planned at the beginning, but it's a very long-term commitment, and also a long-term to sustain the support from your employees and all your stakeholders and your investors, along this journey. Then a third thing, and that's probably one of the most difficult for most companies to do, is that you might be forced, in order to move to net zero, to walk away from potentially profitable activities. And so whether that is, as an example, some of the banks that say, well, they are no longer going to finance coal-fired plants, for example, or even new coal mines. Well, they can very profitably finance those, and they can probably even exit those financing transactions before those mines or things close down. But for all the reasons, investor pressure, regulatory pressure, social pressure, they've been saying, well, actually, we need to walk away from this. And that's not an extreme example, but it might be in different cases in your organization that there are some things that are still currently profitable that you say, well, actually, this is just no longer compatible with the future we need to try and build, and it's sort of a distraction for where we need to go. And it might actually be strategically the right decision to walk away from things that are still currently profitable. A fourth reason then is because it involves, this whole transition involves your entire value chain. So it's not just about your operations, and switching off the lights and changing your energy supply and so on. It is also what happens, who supplies you, and what happens in the markets, and who you sell to. And you obviously don't have full control over it. And this, I just took this from BHP because it just indicates the idea of there's an element of control that you have, but it's also important to think about partnering and influencing throughout that entire value chain. And when you are asked to make commitments, you probably don't have control over every aspect of that. And that's quite a scary thing for most companies to commit, as Pablo said, commit to a goal of decarbonizing an entire portfolio as a large investor. But that depends on the actions of many others. And so how are you going to navigate that? And then the final thing, and this comes from the TCFD, so the Task Force on Climate-Related Financial Disclosure, is that it really requires alignment across your entire organization, from the most high-level governance and board level that needs to take accountability for an integrated climate strategy. Then it needs to permeate through your strategy. It can't just be separate from your strategy as an approach that you roll out to appease certain stakeholders. It needs to factor in both the risks and opportunities in your core strategy. It has to have these risk management metrics which you can measure and track, And you have to set kind of targets and monitor it like you would do for everything else in your organization. So every aspect, from the board and the CEO and the CFO and the risk officer and the operations people are all involved, and you need alignment across the organization. And so one of the frameworks which we use when we help, and this is what Collected Climate works, when we help organizations think through this, is there's sort of a circular wheel process of developing an integrated strategy using a scenarios-based approach. And it's again, doesn't have your scenario standing separate from the organization, but it really starts with identifying the risks, the key things that can damage your business. That leads you to identify what are the kind of scenarios which you probably need to test, develop those. You then develop your risk, your strategy and your metrics, and then you go back and then you test your strategy against these scenarios to see, is it robust? Because ultimately, that's the thing, there's not a perfect strategy against this, and we have to move away from the most efficient strategy, but rather thinking about robust and resilient strategies against these changes. And then finally, I just want to end on, is it possible, a case study? And I know some of the very sharp people on this call have already highlighted and asked, about BHP, given a notice today or a report today that institutional shareholder group, also Glass Lewis, as one of the kind of proxy advisors, have advised against their new climate action plan. And despite that, and actually that actually illustrates some of the complexity, I think it's still worth to just highlight as an approach BHP, not because I said everything is perfect about it, but you can start seeing what is required from an approach. As I said, and even then, this progressive approach is still not sufficient to meet all stakeholder expectations. But so what BHP has done is they've developed over years kind of detailed climate scenarios and then analyzed their business. And these have gotten better over the years. The first ones we could have said, well, not sure it's so robust, but they have improved over the years, and they can then test and inform their strategy. They've committed to reduce operational emissions, in line with their net zero by 2050, but also with interim targets and short-term targets, which is what shareholders are really, really looking for. And then they are saying, well, we need to do something about our value chain, so kind of scope 3 emissions, things outside our control. And there they are partnering, with shipping companies that are really a key source of emissions in their supply chain, as well as with steel makers, sort of their end users of their products, investing money in R&D, partnering with other organizations to see how can they reduce and get that down to zero as well. But that's obviously an area where Glass Lewis feels they haven't done enough yet. And then adapting all their physical infrastructure to a changing climate, and with that producing again better and better plans on how they're going to climate proof their existing infrastructure. They've changed their entire portfolio mix to be more forward facing. So announced the exit out of thermal coal. In the process of kind of spinning off their oil and gas into sort of a separate entity, and going all in on what they call future-facing commodities, copper, nickel, potash, that is required in a net zero world. And then supporting broader legislative and social measures to get everyone on track for this net zero, and reporting very clearly on this. So again, I'm not holding this up to say, well, they're all there. I don't think there's almost anyone who can be fully there given the incredible complexity of this, but more as an approach that is indicative or instructive for how you can think through what it requires to get on this journey. And so with that, I'm going to stop and really invite some questions. And I know we already had a question, and probably you can maybe jump in here as a first on that, is maybe for you as an investor. So I highlighted Glass Lewis, who made the recommendation that the shareholders, they advise vote against BHP's new climate transition plan, predominantly because they feel they don't go far enough in their scope 3 net zero claims. What are your thoughts about that?
Sure. And I have to be honest, I'm not across BHP specifically, or we don't invest in them, but I would say that it's indicative of a couple of trends which are really important. And so if you look internationally, Shell had a vote for their climate plan earlier in 2021, and it was supported not by a huge margin, but supported by shareholders around 60%, I believe, from memory. And then it was struck down by a Dutch court who found that the plan was inadequate and not going fast enough. And so I think what you're starting to see is real, even for those that have purported to be leaders, real scrutiny of the plans and of the commitments to say, well, how does this actually fit with a 1.5 or 2 degree world? And in the case of companies like BHP or any really developed world company, you've got to question whether 2050 is fast enough, because you've got the whole world economy needs to be net zero by 2050 within a budget in order to achieve those climate outcomes. And so if BHP is going to wait, is able to justify waiting to 2050, or Shell or BP or all of those other companies who are making those 2050 type commitments, what of the companies in India? What of the companies in Latin America? What of the companies in Africa? And so I think a lot more scrutiny and a lot more pressure is going to come on developed world companies, particularly large companies who are making very significant profitable profits to do more and to do it faster. I think the other thing that's quite interesting, which I don't know whether it came up in Glass Lewis's commentary or not, is this idea of BHP selling its oil and gas assets off to Woodside. It's arguably no longer BHP's problem, but it's still a problem. And so where do we find the kind of model that allows for the safe closure and decommissioning of those assets before the end of life? And so Dirk, you mentioned walking away from profitable activities. One way to do that is as they've done, which is to sell off, although I'd imagine they've lost some money on their oil and gas assets over the time that they've bought them, but to walk away from them or to sell them. But another is to actually safely close them ahead of time. And this is a very pertinent question for another large listed company that had a shareholder resolution a few weeks ago in AGL, whereby the shareholders again supported more aggressive targets from them because they have this big legacy base of coal-fired assets, which are not going to close fast enough to really be consistent with the demands of the science.
I think maybe, yeah, great. I think maybe the only thing to add from my side is to reiterate that point, is that things are really moving rapidly, and it is sort of, it's a, in the past on many of these things it was a race to the bottom, but now it's really a race to the top. Is that whatever was considered best in class 2 years ago is no longer sufficient anymore. Investors have really smarted up on this very rapidly, and in the past, just you put out a climate document and you've got a big tick from all the rating agencies. Now people are going and interrogating, is your scope 3 emissions out to 2050 ambitious enough, and is a 30% reduction target in the next 5 years, is that enough? So just to say that the pressure is really increasing because the urgency is so great. I guess maybe on the other end of the spectrum, we've got a question saying, well, if I'm a leader in my organization, but the executive team is not yet taking this really seriously. They don't yet have a plan to get to net zero. How can I make a difference? And I guess over here, maybe with things like LTorum, sort of your other hat that you wear, it's probably a great resource that can help people in exactly that position kind of make that case. And what would you advise?
Great. So thanks, Dirk, and appreciate you mentioning LTorum, because we've established LTorum. It's a not-for-profit sustainable finance library, but relevant to business more broadly. And the entire purpose and reason for existence there is to support people to make the case for sustainability within their organization. So exactly that use case. And the way that we have done that is to try and really narrow down the types of cases, the arguments that you need to make in order to shift minds within organisations, because clearly organisations are getting a lot of pressure from external forces, but employees have a role to play in trying to encourage organisation leaders to move faster and to do these issues more quickly. And so the 4 cases that we talk about are the ethical case, which often doesn't get discussed, but there's clearly, as stewards, as responsible corporations, we have a duty to try and do the right thing in these areas. We talk about the business case, and many of these emission reduction efforts save money, particularly around energy efficiency. Increasingly, you're seeing with renewable energy power purchase agreements that they can be secured for cheaper than wholesale prices, and so the shift to renewables will reduce, has the potential to reduce energy costs if you're large enough and able to take advantage of those, even in terms of installing your own renewables into your own facilities. And there's great opportunities there. There's also a business resilience aspect to it, because as we've seen with COVID, is trying to be able to plan for those types of changes, whether it's the physical impacts of climate or the transition risks, is really about building resilience into your business into the future. And so, and then we have the economic case and the investment case, which is just really around how you can invest profitably to create this change. And the economic case is that these things are going to happen, and either you're going to be on in the stream with it, you're going to have a tailwind, or you're going to have a headwind, depending on the business decisions that you make. There's structural changes in the economy and the way that it operates. And so what we're able to do is then, with all of the research that we summarize within the library, is to link it to those cases, so that depending on whether you're talking to your chief financial officer, talking to your CEO, your board, talking to your head of product, you can try and tease out the different cases that you can make. The other organisation I'd suggest is Work for Climate. So they're run by the Sunrise Project. You can sign up to Work for Climate on their website. They have specifically, similar to LTorum, although much more focused on particular outcomes, like joining RE100 as a renewable energy goal, and also switching the default super fund for organisations to be a sustainable one. And they have a couple of other objectives as well. And so they have a lot of resources there to help support employees to make the case for those changes within those organisations. So the help is certainly at hand, and encourage you to reach out, and we'd love to help you with that task. And
that, I think that invitation also extends to us. Really the purpose of programs like this, and the ones we do run, have really been, we found quite helpful for organizations to build that case and sort of really take it from this conceptual level to a far more strategic, business aligned approach. So, and that's certainly why we do the kind of things which we do as well.
So just to, if I may, just on education, because I think your course and what we're trying to do at LTorum is incredibly critical. I'll just give you one quick example, because I know we're short on time. The CFA Institute, which is the peak body for investment analysts globally, surveyed their charter holders earlier this year, and of 7,000 surveyed, only 11% felt that they were proficient at incorporating these sustainability issues into their investment analysis. And so the role of really bringing all industries, not just the investment industry, up to speed from an educational standpoint is absolutely critical, because you can't expect that we're going to make these changes if the people that need to make the changes don't know how. And so that it's very, very important.
And yeah, so thanks, Pablo. And we've got a lot of questions, great questions, which unfortunately I think we're going to run out of time to answer. I think we'll do our best with our colleagues in the business school to answer those in some way. But maybe just to end on quite a positive note, there's a question around opportunities in this transition. Now we've highlighted, Pablo, have drawn your attention to Project Drawdown, and also the Decarbonization Futures report from ClimateWorks, which outline some of the things that need to be done. And everything that's need to be done is an opportunity. There's this on one level, you think, if you have an opportunity mindset, this is the greatest transformation, in the shortest space of time that we've probably had. I mean, generation investment managers, have previously said, this has sort of got the scale and the impact of the Industrial Revolution but sort of with the speed or more of the kind of IT revolution. So if you think, that our entire economy is based on, fossil fuels and everything that's aligned with that, and all of that needs to change in 30 years, there is endless amount of opportunities. And so whether that is, improving in efficiency, helping people solve some of these problems, even helping them deal with some of the physical impacts, because those are certainly going to be real, regardless of how fast we transition. So I think consumer demand is rapidly growing. If you're directly in that space, again, in any of those sectors, there's almost an endless amount of opportunities. But I guess the best way to maybe think about that is to sort of start with this net zero mindset and see if everything needs to be zero across the economy, what needs to change, and therefore what can I supply or produce or advise that helps customers or other businesses in that transition. And some of those resources we've highlighted might be a good starting point. But the net zero frame is actually really helpful to actually unlock the thinking there. I apologize if we won't get to everything else, all the questions, but I think I'm going to hand over to Georgia to just draw this session to a close.
Thanks so much, Dirk. And thank you all for joining us today. That's unfortunately all we have time for. As Dirk and Pablo mentioned, we've had some fantastic questions and we will do our best to address those in the post-event communication that will be sent out. I really do hope you've all enjoyed the session and the insights and expertise from Dirk and Pablo, and that you're all inspired around an approach to get your organisation on board to a net zero approach. Pablo, I love what you said around you can have a headwind or a tailwind. I think we should all get behind it and get that tailwind happening. I also just wanted to mention that we do have an upcoming program that you can join Dirk on coming up in February around climate change and business risk. It's a short course that's delivered over 4 weeks, and in the program we'll show you how to move past short-term pressures, policy uncertainty and the difficulty of organisational system change to develop and implement a strategic approach for successfully integrating climate change into your business strategy. Be sure to follow that QR code you're seeing on screen. So thank you to everyone who has joined us, and a big thank you to Dirk and to you, Pablo. We really appreciate your time today. Take care, everyone. Stay safe, and we hope to see you at our next event. Thank you very much.
Thank you.
Thank you. See you.